How did a 158-year-old Wall Street titan evaporate over a single weekend, taking the global economy down with it? The answer lies not merely in the mathematics of toxic assets or the sudden evaporation of market liquidity, but in a catastrophic convergence of regulatory miscalculations, international political standoffs, and an institutional hubris that blinded the firm's leadership to its own vulnerability. Over the course of 72 hours in September 2008, the highest echelons of global finance and government engaged in a frantic, ultimately doomed effort to prevent the largest bankruptcy in human history. When the dust settled, Lehman Brothers was gone, leaving behind a shattered global economy. To understand the sheer scale of the shock that hit the financial system in September 2008, one must first appreciate the legacy of Lehman Brothers. The firm traced its humble origins back to 1844, when a German immigrant named Henry Lehman founded a small general store in Montgomery, Alabama. By 1850, it had formally become Lehman Brothers, a firm that would survive the American Civil War, the Great Depression, 2 World Wars, and the aftermath of September 11, 2001. Over 158 years, it evolved from a regional commodities broker into the 4th largest investment bank in the United States, commanding a global workforce of 25,000 employees and a towering presence in the financial districts of New York and London. However, by 2008, the traditional business of providing financial advice and brokering trades had been largely eclipsed by a far more dangerous pursuit. In the early 2000s, Lehman Brothers transformed itself into a massive proprietary trading house, taking enormous risks with its own capital. It became deeply entangled in the booming real estate market, fueling a culture of aggressive growth that prioritized immediate, outsized returns over long-term stability. The firm's leadership, convinced of their own invincibility, built an empire resting on a foundation of extreme debt and increasingly worthless assets. When the housing bubble burst, the 158-year-old institution found itself entirely unequipped to survive the fallout. The crisis that culminated in the destruction of Lehman Brothers was not an accident. It was the product of a deliberate corporate strategy centered on maximum leverage. By the beginning of 2008, Lehman had achieved a staggering leverage ratio of 44-1. For the general public, leverage is simply borrowed money. A ratio of 44-1 meant that for every single dollar of its own actual equity, Lehman held $44 in debt. Operating with such extreme debt left the firm incredibly fragile. The mathematics of this position dictated that a mere 2.5% decline in the value of the company's assets would completely wipe out its stockholders' equity, plunging the entire enterprise into insolvency.
The danger of this leverage was compounded by what Lehman was actually buying with all that borrowed money. While the 2008 financial crisis is broadly remembered for subprime residential mortgages, Lehman's fatal weakness was its massive exposure to the commercial real estate market. As other financial institutions began to reduce their risk and hunker down in early 2007, Lehman actually increased its pace of principal investments in commercial real estate. In May 2007, the firm committed an astounding $11 billion to acquire the Archstone Real Estate Investment Trust, a massive $22 billion joint venture. This single transaction drastically breached the firm's own internal risk limits, which had originally been set at a mere $720 million. When the credit markets tightened and Lehman could not find other buyers to share the burden, it was forced to directly fund the riskiest $6 billion of the deal, trapping toxic, unsellable assets on its balance sheet. Adding to the peril was how Lehman valued these assets. A significant portion of Lehman's portfolio consisted of what accountants call Level 3 assets. These are investments that do not trade on open markets and lack a readily available pricing mechanism, meaning they are highly illiquid. In a rapidly declining real estate market, the value of these assets should have been aggressively written down to reflect reality. Instead, an independent bankruptcy examiner later found hundreds of instances of static marks, where Lehman's executives left the valuations of these corporate equity positions completely unchanged for up to 15 months. By refusing to acknowledge the reality of the plunging market, Lehman's leadership created a phantom balance sheet that presented a facade of solvency to the outside world. To mask the severity of its leverage from the public and regulatory authorities, Lehman Brothers resorted to elaborate accounting subterfuge. The most notorious of these maneuvers was a practice internally known as Repo 105. In the normal course of banking, institutions use repurchase agreements, or repos, to secure short-term, overnight funding for their daily operations by pledging assets as collateral. However, Lehman utilized an accounting loophole to classify a specific subset of these short-term loans as actual sales. This technicality allowed Lehman to temporarily move up to $50 billion of highly questionable assets completely off its balance sheet just days before the end of financial reporting quarters. Once the quarterly financial statements were published showing a much healthier, lower-leveraged institution, Lehman would immediately repurchase the assets. According to the exhaustive 2,200-page report authored by court-appointed bankruptcy examiner Anton Valukas, this practice had absolutely no legitimate business purpose. Its sole function was to artificially and deceptively reduce Lehman's net leverage, thereby misleading investors, creditors, and the broader market about the firm's true viability. There were internal warnings, but they were ignored. In June 2008, a Lehman senior vice president named Matthew Lee blew the whistle, writing a letter advising the firm's auditors and audit committee that Repo 105 was being used improperly to manipulate financial information. Despite specific requests by the committee to look into the matter, the firm's external auditors, Ernst & Young, failed to adequately investigate the allegations or advise the audit committee of the gravity of the situation. This failure to report the truth left the public entirely unaware of the precarious financial precipice upon which Lehman was teetering. The direct path to the fateful September weekend was paved in March 2008 with the near collapse of a rival investment bank, Bear Stearns. Facing a sudden run on its own liquidity, Bear Stearns was rescued from bankruptcy through a government-engineered acquisition by JP Chase, backed by a $30 billion emergency loan from the Federal Reserve. This intervention created a profound sense of moral hazard across Wall Street. It established a prevailing, unwritten assumption that the United States government would simply not allow a major financial institution to fail outright because the systemic risks were too great. Operating under the belief that the government would ultimately provide a safety net, Lehman's chairman and CEO, Richard Fuld, dug in his heels. Instead of aggressively seeking a buyer or taking painful losses to clear the firm's books, Fuld proved highly resistant to deals that he felt undervalued the institution. During the summer of 2008, as market panic intensified and Lehman's stock price plummeted, the firm entered into confidential negotiations with the state-owned Korean Development Bank regarding a massive capital infusion or total buyout. The Korean bank, sensing the desperation, offered to purchase Lehman at $26 a share. Convinced that his firm was worth more, Fuld rebuffed the offer, deeming it too cheap. It was a fatal miscalculation. When news of the failed negotiations inevitably leaked to the financial press in early September, Lehman's stock price entered a free fall. The market realized that no foreign white knight was coming to the rescue. The crisis of confidence reached a boiling point on Wednesday, September 10th. In a desperate attempt to get ahead of the rumors, Lehman pre-announced its third-quarter earnings. The numbers were disastrous, a projected net loss of $3.93 billion and an astonishing $5.6 billion in write-downs tied to its toxic real estate portfolio. Lehman also announced a convoluted plan to spin off its commercial real estate assets into a separate, publicly held bad bank, but investors saw this as a hollow gesture. The financial plumbing of the firm immediately began to seize up. Lehman relied heavily on the tri-party repo market, requiring billions of dollars in overnight loans simply to open its doors and clear its trades each morning. JP Chase, acting as Lehman's primary clearing bank, watched the plunging value of Lehman's assets with mounting alarm. Fearing massive exposure, JP executives, led by CEO Jamie Dimon, began demanding billions of dollars in additional collateral from Lehman to cover its daily trading activities. By Friday morning, Lehman's available collateral was entirely exhausted. The bank was completely frozen out of the short-term credit markets. Without immediate intervention, the firm would not be able to open for business the following week.
As dusk approached on Friday, September 12th, the gravity of the situation forced the government's hand. United States Treasury Secretary Henry Paulson, a hard-charging former CEO of Goldman Sachs, recognized the systemic threat but was politically trapped. Just days prior, the government had placed the massive mortgage giants, Fannie Mae and Freddie Mac, into federal conservatorship to prevent their collapse, committing billions of taxpayer dollars in the process. The American public and political establishment were furious at the seemingly endless string of Wall Street bailouts. Paulson drew a hard line in the sand, reportedly declaring to colleagues that he refused to be known as Mr. Bailout. He concluded that deploying taxpayer funds to save Lehman Brothers would create intolerable moral hazard and signal to every reckless bank that the government would always clean up their messes. Paulson, accompanied by Timothy Geithner, president of the Federal Reserve Bank of New York, summoned the chief executives of the major Wall Street banks to the Federal Reserve's fortress-like building in Lower Manhattan. The executives arrived expecting to negotiate a Bear Stearns-style government rescue. Instead, they were met with an ultimatum. Geithner and Paulson informed the stunned room that the government would not provide a single penny to backstop Lehman Brothers. The crisis was Wall Street's problem, and Wall Street had until Monday morning to solve it, or Lehman would be allowed to file for bankruptcy. As the weekend began, the search for a private sector buyer focused entirely on two institutions, Bank of America and the British bank Barclays. Bank of America possessed the balance sheet to absorb Lehman, but its leadership quickly realized the catastrophic depth of the rot within Lehman's real estate portfolio. Concurrently, Bank of America's CEO recognized another distressed Wall Street giant, Merrill Lynch, was also available for acquisition. Over the course of the weekend, Bank of America quietly abandoned the Lehman negotiations and pivoted, striking a deal to acquire Merrill Lynch for $29 a share. With Bank of America walking away, the survival of the 158-year-old titan rested solely on the shoulders of Barclays. Bob Diamond, the ambitious president of Barclays, viewed the crisis as a historic opportunity to acquire a premier Wall Street franchise at a fire sale price, propelling the British bank into the top tier of global finance. However, Diamond and his team were not reckless. They were highly interested in acquiring Lehman's core brokerage and investment banking operations, but they definitively refused to absorb the billions of toxic commercial real estate assets that were poisoning Lehman from the inside.
On Saturday morning, the atmosphere at the New York Fed grew increasingly desperate. Because Barclays refused to finance Lehman's bad bank assets, Paulson and Geithner pressured the assembled Wall Street CEOs to form a private consortium. The plan was for the rival banks to pool their money and fund a lifeboat to guarantee Lehman's toxic real estate, absorbing the losses so Barclays could safely purchase the healthy parts of the business. The room of Wall Street titans was paralyzed by self-interest and terror. Every CEO present knew that their own balance sheets were laden with the same toxic mortgages and commercial real estate loans. Funding a multi-billion-dollar backstop for Lehman seems tantamount to financial suicide. Furthermore, as rival bankers finally got a look at Lehman's internal books, they were appalled by what they found. Lehman's valuations of its commercial real estate were wildly optimistic. The bankers deduced that in any real-world fire sale, the assets would be worth less than half their stated value, completely wiping out Lehman's remaining equity. When investigators later asked JP Morgan CEO Jamie Dimon if Lehman had actually been solvent that weekend, he replied bluntly, "I don't know. I still could not answer that question." While the American regulators battled with Wall Street egos in New York, a secondary and ultimately fatal conflict was brewing across the Atlantic Ocean. Barclays' bid to acquire Lehman was subject to the regulatory authority of the United Kingdom, specifically the Financial Services Authority and the Chancellor of the Exchequer, Alistair Darling. From the moment Barclays emerged as a potential suitor, the British authorities harbored deep existential reservations. At a meeting of European finance ministers in Nice, France, Chancellor Darling and Bank of England Deputy Governor Sir John Geeve discussed the potential takeover. Geeve vehemently opposed the deal, describing the idea of a British bank taking on Lehman without a massive financial backstop as crackers.
The UK regulators, led by FSA Chief Executive Hector Sands and Chairman Sir Callum McCarthy, examined the proposed transaction and saw a catastrophic risk to the entire British financial system. Taking on Lehman's massive, complex trading book required an enormous capital cushion. The FSA calculated that even if Barclays could somehow satisfy baseline capital requirements, the sheer aggregate level of systemic risk imported into the UK economy would be entirely unacceptable. The core issue was a matter of corporate law and financial guarantees. To execute a transaction of this magnitude under UK listing rules, Barclays was legally required to hold a shareholder vote to approve the acquisition. Organizing and executing this vote would take anywhere from 30 to 60 days. During this 2-month limbo, Lehman's vast trading operations and open derivatives book would remain highly volatile. Barclays could not legally guarantee Lehman's massive obligations prior to the shareholder vote without risking its own immediate insolvency. Therefore, Barclays and the British regulators issued a strict, non-negotiable condition for the deal to proceed. The United States government, or the Federal Reserve, had to provide a financial guarantee to backstop Lehman's trading obligations until the Barclays shareholder vote could be completed. This demand struck directly at the heart of Paulson's strict no bailout doctrine. To provide a blanket guarantee for Lehman's open trades was, in the eyes of the U.S. Treasury, functionally equivalent to a bailout, putting American taxpayer money at risk to facilitate an acquisition by a foreign institution. It was a political impossibility for Paulson. On Saturday evening, as the transatlantic stalemate hardened, the terrifying reality of the situation began to dawn on those involved. In London, Tony Lomas, an insolvency expert at the accounting firm PricewaterhouseCoopers, received a jarring phone call while eating at a Chinese restaurant in Essex. The voice on the line advised him to abandon his dinner and immediately begin contingency planning for the bankruptcy administration of Lehman's massive European arm. The clock was running out. Sunday morning arrived with an atmosphere of desperate delusion in New York. Lawyers for Barclays and Lehman Brothers continued to feverishly draft merger documents, hoping a last-minute compromise could be found. At the New York Fed, the assumption stubbornly remained that the British regulators would eventually blink, waive their shareholder vote rules, and allow the deal to proceed to save the global economy. The Americans severely underestimated the rigidity of UK corporate law and the protective instincts of the British government. In London, Sir Callum McCarthy spent a deeply frustrating morning trying to extract concrete details from his American counterparts regarding how Lehman's liabilities would actually be managed during the transition period. The answers were wholly insufficient. The United States authorities were unwilling to provide a guarantee that extended beyond the upcoming change of the U.S. presidential administration in January 2009, offering no comfort to the British regulators. The definitive breaking point occurred at lunchtime in New York, which was late afternoon in the UK. McCarthy spoke directly with Geithner, formally stating that the FSA would under no circumstances waive its regulatory requirements and would not allow the deal to proceed without a firm, open-ended financial guarantee from the U.S. government. Shortly thereafter, Barclays CEO John Varley called Hector Sands to confirm the inevitable. Lacking the U.S. backstop, Barclays was officially withdrawing its bid to acquire Lehman Brothers. The sudden collapse of the Barclays deal sent profound shockwaves through the Federal Reserve building. In a frantic, last-ditch effort to salvage the situation, Hank Paulson initiated a direct telephone call to the British Chancellor Alistair Darling, who was at his constituency home in Edinburgh. The conversation between the two finance chiefs was stark, blunt, and unforgiving. Paulson pressed Darling to override the FSA and approve the Barclays takeover to avert a global financial catastrophe.
Darling, however, was absolutely resolute. He understood that without a U.S. guarantee, the British taxpayer would ultimately be left standing behind the radioactive liabilities of a failed American investment bank. Darling's logic was grounded in sovereign self-defense. He later reflected on his thought process, stating, "My first reaction was, if this is such a good deal, how come no American bank is going to go near it?"
Darling formally vetoed the transaction, telling Paulson that there was no way Britain would import the liability of an American bank that might collapse the following week. Paulson reacted with deep bitterness, expressing dismay that the UK had allowed negotiations to proceed so far before pulling the plug. Darling maintained that the Americans had been fully aware of Britain's regulatory prerequisites from the very beginning of the weekend. With Barclays officially gone and Bank of America having already defected to purchase Merrill Lynch, Lehman Brothers was completely out of options. There was no white knight, there was no government bailout. The only remaining path was bankruptcy. The realization of Lehman's inevitable demise created an immediate logistical nightmare. A Chapter 11 bankruptcy requires extensive legal and operational planning to ensure an orderly wind-down, especially for a broker-dealer with deeply interconnected global operations. Lehman, operating in a state of denial, had undertaken almost no substantive preparation. Throughout the weekend, Lehman's external legal counsel, senior partners from the prestigious law firm Weil, Gotshal & Manges, had been operating under the assumption that a rescue deal would be finalized. On Sunday afternoon, as the Barclays deal disintegrated, 4 Weil partners, including legendary bankruptcy attorney Harvey Miller, were riding in a taxi stuck in traffic in Lower Manhattan, heading toward the Federal Reserve. While in the cab, they received frantic calls from clients who had been inside the Fed meetings. The clients delivered a shocking message. The Federal Reserve had just announced to the assembled Wall Street executives that Lehman Brothers would be filing for bankruptcy that night. The lawyers were floored. The decision to place their client into Chapter 11 had been dictated by government regulators without the company's legal counsel even present in the room. When the lawyers arrived at the Fed, they were bluntly informed by government officials that Lehman's holding company must file for bankruptcy before the global markets opened on Monday morning.
At 7:55 p.m. on Sunday, Lehman's board of directors convened for a final, somber meeting. Government regulators joined by telephone to formally deliver the mandate. Left with absolutely no alternative and facing massive, unmeetable collateral calls from its clearing banks by morning, the board authorized the filing. At 1:45 a.m. on Monday, September 15, 2008, Lehman Brothers Holdings Inc. electronically filed a Chapter 11 bankruptcy petition in the United States Bankruptcy Court for the Southern District of New York.
It was and remains the largest bankruptcy filing in global history, involving an astonishing $639 billion in assets and $619 billion in debt, completely dwarfing the previous records set by WorldCom and Enron. The consequences were immediate, violent, and planetary in scale. As dawn broke, the iconic images of stunned Lehman employees exiting their global headquarters in New York and Canary Wharf in London, carrying cardboard boxes, became the defining visual epitaph of an era of unfettered financial engineering. Out on the street in New York, the public anger was palpable. An artist brandished a life-size poster featuring CEO Dick Fold's face, covered in angry messages penned by the public, a piece of memorabilia that a former employee later purchased for $10,000. The Federal Reserve and the Treasury had vastly underestimated the extreme interconnectedness of Lehman Brothers and the speed at which systemic contagion would spread. When the New York Stock Exchange opened, the Dow Jones Industrial Average plummeted by 504 points, suffering its largest single-day point drop since the terrorist attacks of September 11, 2001. Over the ensuing weeks, the shock waves contributed to the evaporation of nearly $10 trillion in market capitalization from global equity markets. But the true existential devastation occurred in the hidden plumbing of the financial system, the credit and derivatives markets. The bankruptcy filing acted as a legal guillotine on global finance. While Chapter 11 provides a framework for reorganization, standard bankruptcy protections do not apply to derivatives contracts. Lehman Brothers was a counterparty to an estimated 900,000 derivatives contracts.
The moment the filing occurred, counterparties across the globe scrambled to protect themselves, triggering an uncoordinated, panicked unwinding of positions that resulted in massive fire sales and billions of dollars in instantaneous losses. To manage the immediate catastrophic fallout and facilitate the transfer of customer accounts, the Federal Reserve was forced to provide a staggering $138 billion in Fed-backed advances through JP Morgan Chase over the next 2 days. Furthermore, the sudden halt in operations trapped vast amounts of capital. JP Morgan alone ended up holding approximately $333 million of Lehman's customers for weeks after the failure, as the legal system ground to a halt.
The most terrifying systemic shock occurred on Tuesday, September 16th, within the usually staid and reliable world of money market mutual funds. These funds were traditionally viewed by corporate America and retail investors as a perfectly safe alternative to cash, reliably maintaining a net asset value of $1 per share. However, many prime money market funds had heavily invested in high-yielding corporate debt to boost their returns. The Reserve Primary Fund, one of the oldest and largest money market funds managed by industry pioneer Bruce Bent, had significantly increased its holdings of commercial paper, including $785 million of unsecured debt issued by Lehman Brothers. When Lehman defaulted on this commercial paper, the Reserve Primary Fund's asset values plunged. The fund was forced to write off the Lehman debt, causing its net asset value to drop to $0.995 per share, an event known in financial parlance as breaking the buck. The psychological impact of this specific event cannot be overstated. It destroyed the foundational illusion of safety in the short-term funding markets. Panicked investors, terrified that their safe cash equivalents were evaporating, initiated a massive run, attempting to redeem more than $300 billion from prime money market funds in a matter of days. To meet these massive redemption requests, money market funds were forced to hoard cash and dump their assets, completely halting their purchases of new commercial paper. Overnight, the primary mechanism that global corporations used to finance their daily operations, manage inventory, and meet payroll effectively ceased to function. The interbank lending market froze entirely. Banks stopped lending to one another because no institution could be certain that its counterparty wasn't hiding the next massive exposure to toxic assets. The contagion rapidly crossed borders, entirely validating Chancellor Alistair Darling's fears. In the UK, the panic triggered a catastrophic run on the banking sector. HBOS, the UK's largest mortgage lender, saw its share price collapse so violently that it was forced into a hasty government-brokered rescue acquisition by Lloyds TSB on September 17th. Within days of Lehman's collapse, the strict ideological parameters established by Henry Paulson on Friday evening were entirely obliterated by the reality of a global economic meltdown. On Tuesday, September 16th, facing the total collapse of the global financial system, the U.S. government was forced to execute an $85 billion bailout of the insurance giant AIG, an intervention that made an absolute mockery of the administration's stand on moral hazard. Within 2 weeks, the government orchestrated the rescues or arranged sales of failing banks like Washington Mutual and Wachovia. Eventually, the crisis forced the creation of the Troubled Asset Relief Program, directly injecting hundreds of billions of taxpayer dollars into the banking system to stop the bleeding. In the bankruptcy courts, Barclays eventually purchased Lehman's North American investment banking and trading operations, along with its New York headquarters, for a fraction of their previous value, leading to years of complex litigation over billions of dollars in disputed clearance assets. In the years following the crash, a fierce historical debate emerged regarding the legality and necessity of letting Lehman Brothers fail, often referred to as the Lehman myth. Federal Reserve Chairman Ben Bernanke, Treasury Secretary Henry Paulson, and New York Fed President Timothy Geithner consistently maintained that the government did not consciously choose to let Lehman fail to prove a point to the markets.
They argued that the Federal Reserve simply lacked the legal authority to extend emergency credit to Lehman because the firm did not possess sufficient high-quality collateral to secure the loan as required by the Federal Reserve Act.
However, subsequent academic research and investigative analysis have rigorously challenged this official narrative. Detractors argue that the collateral argument was largely an ex post facto justification designed to obscure a disastrous policy choice driven by political optics and an overwhelming fear of public backlash. Financial analysts deeply examining Lehman's balance sheet have pointed out that the firm had access to at least $114 billion in available collateral that was theoretically acceptable at the Fed's primary dealer credit facility, more than enough to secure the estimated $84 billion required to fund Lehman through a controlled, orderly wind-down. Critics argue that the Fed artificially restricted Lehman's access to this facility for political reasons, enforcing a strict set of rules on Lehman that they readily waived for other institutions. Furthermore, the glaring inconsistency of government action destroyed any semblance of a coherent regulatory framework. By bailing out Bear Stearns in March, allowing Lehman Brothers to collapse into chaos in September, and then bailing out AIG a mere 48 hours later, regulators created an environment of maximum uncertainty. Market participants could no longer reliably model financial risk because risk was no longer determined by mathematics or asset quality, but by the arbitrary, highly politicized interventions of the U.S. government. The failure of the weekend negotiations also highlights a profound, unrectified structural deficiency in the architecture of globalized finance. Financial institutions like Lehman Brothers operate across borders as seamless, deeply interconnected global entities, yet they remain subject to highly fragmented national regulatory regimes. When the crisis peaked on Sunday, September 14, the survival of an American investment bank with massive global systemic importance ultimately hinged on the strictures of UK corporate shareholder voting laws and the domestic political calculations of the British Chancellor of the Exchequer. The international system lacked a unified legal framework for resolving a globally active, systemically important financial institution. Consequently, when the pressure built to a breaking point, national authorities defaulted to protecting their own sovereign balance sheets, allowing the entity to violently fracture along national borders and spread contagion worldwide. The 72 hours that ended Lehman represent a masterclass in institutional failure and regulatory paralysis. The evaporation of the Titan was not merely an unavoidable consequence of natural market forces, but the culmination of systemic recklessness enabled by accounting subterfuge and hubris. Ultimately, the weekend serves as a grim testament to the catastrophic consequences of reactive policymaking. The resulting bankruptcy did not cleanse the system of moral hazard. Rather, it forced governments worldwide to socialize private losses on an unprecedented scale to prevent a total economic collapse. It remains the definitive cautionary tale of modern finance, a warning that in a hyper-connected global economy, the sudden failure of a titan carries the power to break the world.